Good afternoon. My name is Nicole Teska, an audit partner at Bowers Company CPAs. In what seems like a world full of webinars, we are honored that you took time out of your day to listen to ours. We anticipate the webinar will take about 30 minutes and then we'll take questions at the end. As we go along, feel free to type questions in the questions box and we'll get those answered at the end as much as time allows. I'm going to try to stave off one question now and let you know we will provide you with a link to the archived video as well as a slide deck at the end of the presentation. As you would imagine, we are doing this webinar with all panels being remote, so we apologize if there are any interruptions in the communication. Now, all disclaimers being said, today's webinar is on a cash flow forecasting and how it's important not only during uncertain times, but in normal business operations as well. Our presentation is brought to you by two of our audit managers, Jen Richardson and Joe Rocco. Jen has been with Bowers & Company for 6 years, and Joe joined our company in October 2019 after having spent 10 years with PwC Boston. And now Jen will start off the presentation.
Thanks, Nicole. A few topics that we are going to hit today are what is forecasting, why is it useful, assumptions and questions to consider, high-level examples of inflows and outflows, actions to take, best practices, and then as Nicole mentioned, we will have some time at the end to answer any questions that come in during the webinar.
Great, thanks, Jen. I'm sure by now all of you are equally as ready to turn the page on COVID-19 and are anxiously ready to return to what we remember as normal. Recent projections seem to indicate social distancing is working to slow this virus, so we are hopeful that we are starting to see the curve flatten and that the end to the New York pause is in sight. It's no surprise that US economic activity has slowed in recent months as millions practice social distancing to stem the spread of COVID-19. As a result, companies are currently experiencing or anticipating significant constraints on cash and working capital, including potential liquidity challenges. Cash flow scrutiny will be crucial in the days and months ahead, as will the speed at which the $2 trillion US economic stimulus package that passed on March 27th starts to flow through the economy. Managing cash pressures often falls directly on finance departments during a crisis. Executives will balance these pressures against the prospects for relief as details continue to unfold about the stimulus package's significant tax provisions and other measures designed to assist individuals and businesses. Depending on the industry, many companies will see lower revenue resulting in less cash flow, along with delayed collection of receivables as needs grow to step up payables to important suppliers. Companies should expect to become much more nimble in managing inventory given the uncertainty in the supply chain, which will also place demands on working capital. We know many of you are facing difficult decisions around short-term workforce reductions and are also dependent on supplemental federal benefits to help bridge your operations through this crisis, as all industries have experienced some level of disruption in the recent months. The information we are going to share with you today is based on our experience helping companies manage their cash and liquidity positions during times of high uncertainty.
All right, next we are going to talk about what is cash flow forecasting. So cash flow forecasting is an estimate of the amount of funds you expect to flow in and out of your business during a set period of time. It is important to note the difference between your income statement and your cash flow forecast. A cash flow forecast assists with projecting your financial position over time, while the income statement reflects expenses that have already been incurred. Effective cash flow forecasting assesses multiple scenarios, often best and worst case, over both short and long-term periods. Cash flow forecasting can be considered similar to a budget, so you should be using similar assumptions. But since budgets are usually for a year, cash flow forecasts are for a shorter period of time and do not include non-cash items such as depreciation. So you can kind of think of it as reconciling your bank account before the inflows and outflows happen. All right, Next, we're going to go into why is cash flow forecasting useful? Since we are in a time of economic uncertainty, as Nicole mentioned, cash flow forecasting helps highlight periods in time where there could be potential cash shortfalls. This is helpful to know sooner rather than later, so decisions can be made to try to right the shortfall. Examples of that could include adjusting timing of payments to vendors or other necessary reduction to business expenses, which unfortunately we have seen with many businesses currently could mean a hopefully temporary reduction in the workforce. Next, we have cash flow forecasting helps to aid in decision making. This is especially true when you're trying to plan for future capital projects. This is a useful tool to aid in the decision on whether to finance the project or to use cash on hand. So your model should show you when you will have a cash deficit to enable you to work with your lending institution early to prepare financing so that there is no delay to the project. Next, we have cash flow forecasting. It's helpful to assess trends in order to assist with short and long-term financial planning. Projecting out actual trends is the best way to ensure that your forecast most accurately reflects your business cycle, and therefore can be relied upon for financial planning purposes. Our next point goes well with the first bullet point, noting forecasts can help you to determine where to allocate resources to be most beneficial to your business. And next we have, during uncertain times, cash flow forecasts with shorter intervals are more helpful in decision making to navigate your options. This way you're able to easily change assumptions to recalculate the model for different situations that arise. Now I'm going to hand it over to Joe to talk more about these assumptions and what questions are helpful to ask yourself when you're putting the cash flow forecast together.
Thanks, Jen. One of the first components of effective cash flow forecasting is ensuring you understand what the minimum cash requirements in your business operations are. An assessment of available cash and liquidity headroom is paramount. Identify how much cash you have and if it is restricted or readily available for use. Identify the key cash flows that may be exposed. Awareness of cash reserves or shortages, along with the liquidity position, will be a starting point for identifying opportunities to protect and improve your position. Ensure you can answer, what is the cash burn at the most likely projected low revenue level, and what is the likely zero cash date under the worst case scenario? In times of uncertainty, it is important to have models that reflect different possible scenarios and outcomes, which Jen is going to spend more time speaking about shortly. You should be prepared to answer, what's the status of your cash and liquidity runway today, and what do you anticipate it will be during the next 90 to 120 days? Each model should have your assumptions clearly stated and explore different what-if scenarios, such as a drop in sales or a reduction in cash collected, and be prepared to revise them often. It may be beneficial to probability weight various scenarios in your financial models and update these probabilities and your assumptions going forward as more certainty and information becomes available. If you wait for the complete picture, it's likely too late to steer the ship. Scenario planning gives you the confidence to make needed decisions and to shape communications about the response strategy. As we continue on to the next slide, as we mentioned earlier in our presentation, all industries will experience some level of direct or indirect disruption caused by the COVID-19 impacts to our economy. It is essential to not only understand your potential cash and liquidity challenges, but to also try and understand what is happening to your top customers and how does that impact your forecasting. We would recommend keeping open lines of communication with at least your top 5 customers to better understand how this crisis has impacted their cash flow forecasting and what that means for your business arrangements. It is also important to consider all potential sources of cash flows in your forecasting models and consider different likelihoods with these assumptions. For example, we know many of you have already submitted applications for SBA loans, especially as part of the federal Paycheck Protection Program. Ensure that your models consider different best and worst case scenarios, including potentially receiving some relief from SBA loans and what the repayment terms are on those arrangements. Also, we are closely monitoring the potential authorization for additional funding to the PPP, which could mean up to another 250 to 300 billion available in small business funding. We encourage you to review your expenditures and explore if any costs can be deferred or terms be extended with your creditors in order to provide some short-term relief on your cash flows. Another great option is to look into if you are eligible to defer the employer portion of your payroll taxes. The CARES Act allows businesses, regardless of size, to elect to defer paying the employer's share of Social Security tax on wages paid from March 27th through the end of 2020 until December 31st, 2021 and 2022. Do note that the deferral is not available, however, if a business receives a PPP loan and then has all or a portion of the loan forgiven as permitted by the CARES Act. Now I'm going to turn it back over to Jen to walk through some more of this modeling.
All right, thanks, Joe. Now we are going to get into a few examples here of some inflows and outflows. These are just high level. There could be other larger items that relate specifically to your business that you would want to break out separately. So for inflows, we have cash from customer sales, accounts receivable collection, bank financing, sales of assets, sales of investments, and investment dividends. For outflows, payroll taxes, accounts payable, insurance, rent, debt payments, investments, and utilities. And it is important to note that some of these items could be quarterly or annual payments. So when you're putting the model together, you want to make sure it's in the correct month. Forecast cash flow scenarios by understanding which inflows and outflows are fixed and what can be restructured or optimized, resulting in maximized cash flow position, which we're going to dig deeper on the next slide here. So here we have just an example of a cash flow forecast. It is important to remember that it's based off when collections of cash occur and when cash is paid out. So the first step in creating this model would be to determine reliable cash inflows. So you want to start with everything that you know. So first we have cash sales. Assess whether current economic conditions or restrictions will reduce the assumed level of cash sales. If you are a business that relies heavily on foot traffic, then you would want to drastically reduce this number from the trend of your historical collections for a current cash forecast. Also, this model assumes that the business will be back up and running by June. However, since we know as of now that non-essential businesses will be closed until May 15th, and there will be phases of opening the economy, it might be more realistic to assume that business will start to pick up at the end of summer or potentially later. However, since there is no certainty in when business will begin to open, this is a time when multiple forecasts are necessary to assess different opening date scenarios. Then we have AR collection. It's helpful to use your current aging to estimate when certain customers will pay. Is there a certain percentage of customers that pay on time, so within 30 days? Are there customers who consistently pay 60 or even 90 days late? Then come up with a weighted average to determine how much cash you believe will be collected from AR. Dividends, we're going to skip over loan proceeds for a second. Dividends and interest income. These are during normal economic times, these are generally consistent. However, in today's economy, it might be best to err on the side of conservatism and underestimate this inflow. Lastly, we have loan proceeds. So this is going to be a number that can be adjusted based off the ending cash balance when you enter all the information that is known to you. If you come up with a negative balance, then bank financing could be considered, which we will talk about in a moment. So then step 2 would be to record fixed expenses or outflows. These would be expenses that you know will be due and that there's no room for deferral. Under normal circumstances, these would be items like payroll, taxes, insurance, utilities, and debt payments, to name a few. During the present time, as Joe mentioned, there is room for deferral with multiple payments. So once you've put all your fixed expenses in, then it's time to assess which of these can be adjusted. So for instance, debt payments. You should call your bank to see if any of your current loans qualify for deferment, and take into account that if you do defer these payments, the interest could still be accruing during this time. Therefore, when the payments resume, you want to increase your forecasted amount to include the accrued interest portion. Then we have accounts payable. In certain times, it's beneficial to assess which vendor payments can be delayed. So are there vendors who charge interest on late payments and maybe some who won't? Make sure to take into account, again, this interest, like we mentioned with the debt, when the payments are being forecasted. It's also important during current times to be in contact with major vendors for when your business opens back up. Once the economy opens, you want to know what their lead times are, and then also you'll be able to better forecast when these payments will come due. Now we are to payroll. So this is a tricky one. Given the current situation, there are so many scenarios that need to be accounted for in different models. I mentioned this before, but it's always important to have multiple cash flow models, but especially during times of uncertainty. So if you applied for the PPP and were approved, this doesn't mean that this expense does not need to be reassessed. Since there was an increase in the unemployment benefit that is being paid to workers who are temporarily out of work due to COVID-19, there are situations where hourly workers, it might be more beneficial to them to claim unemployment. In this case, it would be important to assess the workforce you need to manage your business and perhaps consider an increase in pay due to the current circumstances. However, if you were approved for the PPP, it is important to assess the workforce you will need in order to take advantage of the forgiveness after 60 days of expenses are paid. If you don't believe, based on your current situation, that you'll be able to have the whole PPP loan forgiven, it would be beneficial to assess any outstanding debt that could be paid down, since the interest rate on the PPP loan is 1%, which could be lower than other debt your business has. If the other debt you have matures within 2 years, that could be something that would help to reduce your interest expense going forward. Now, step 3, we've assessed our inflows already, we've assessed our outflows. Step 3 would be to see if your cash flow for the period, in this case, we're looking at a monthly forecast, is positive or negative. Clearly, in months that are negative, you will need to reach into your reserves or look to the bank for funding to make up the deficit. So since you have created this forecast well before the potential deficit has occurred, you would be able to reach out to the bank to set up a line of credit or start the process for a bank loan in order to get in front of the deficit and have the least interruption to your business. Also, we have focused mainly on maintaining your business during the current time. However, as Nicole mentioned in the beginning, cash flow forecasts are beneficial when you are looking to expand your business or acquire another business. It would be simple to add to your forecast to track separately from your normal AP, any construction invoices, and add any draws for a construction line of credit or loan to the inflows at the top. This way, you would be able to tell if you need to pull from your line to fund the project or use operating cash. So now that you've created your cash flow, let's hand it over to Joe to learn about some actions to take next.
Thanks, Jen. So looking at these next couple slides, we're going to take a couple minutes looking at immediate actions to take. What can you do now? So hopefully these bullet points will help showcase and highlight some of the key elements that we want to talk about with you. So if you haven't already, immediately make it a priority to evaluate all aspects of available federal programs and small business loans and resources for your companies. In early April, a few of our colleagues presented webinars specific to the PPP and tax impacts from the CARES Act. Links to those recorded webinars have been included for those looking for additional information on these topics. The next point is to assess collection efforts and consider the cash flow impact of offering customers discounts for early payments. This may be a great way to bolster your short-term cash flows if facing liquidity concerns, while also giving breaks to your customers in times of need. You can also take steps to control the flow of outgoing payments by considering ways to minimize non-essential outflows, such as discretionary spending and defer capital expenditures. Reassess payment priorities by reviewing vendor relationships to consider opportunities to hold or delay outflows. And while I'm sure the next point won't be a favorite among your employees, consider implementing cost reduction plans that will have an immediate cash impact, such as bonus freezes or the deferral of those payouts. You can right-size inventory to sales by assessing critical material needs and risks to manage supply options. Recalibrate forecasts, replenishment triggers, and targets to control production. Also, deploy financial tactics to ensure lean cash principles are in place, and consider using credit facilities as needed to offset short-term cash constraints. And as Jen mentioned, maintain communications with your current lenders, and if necessary, request deferments. Continuing on to the next slide. Now, there's never a time to shortcut your internal control processes, and I can't stress enough that now is even more so not the time, as it is imperative that you maintain internal cache and cyber controls, particularly in a remote environment. There is an anticipated increase in cyber and phishing attacks, including COVID-19 subject lines. And I know a few individuals out there who have already received fictitious calls requesting personal information, including bank account information, in order to process their stimulus check deposits. So please continue to follow your internal control processes, especially in these times of working remotely, and proceed with extra awareness when it comes to internal cache and cyber controls. Another good question to ask yourself is, do you currently have a contingency plan if COVID-19 disruptions take your back office offline? Accounting services need special consideration in an overall workforce action plan for COVID-19. It is crucial to maintain the ability to collect and pay invoices during any crisis. Some companies have outsourced these activities, while other companies manage accounting in-house locally or through a shared services model. Determine where you need to increase or decrease front and back office staffing to meet remote work considerations. I know some of our clients are currently testing whether they're able to close the books and process transactions remotely with staff working from home. While I'm sure many of you have already completed 1231 audits or reviews, if you haven't yet, or will be going through an audit or review in the upcoming months for your year end, assess your need to seek short-term deadline relief if possible. This may include extensions on financial submissions to lenders in order to satisfy debt covenants or other statutory deadline requirements. Even with relief, we recommend that you evaluate financial reporting needs and resources earlier than usual. This could include evaluating the impact of remote work arrangements and other staffing matters on your financial reporting systems. And lastly, we recommend that you have contingency plans in place to ensure appropriate audit requirements can be met going forward. I know over the last several months, we've had many conversations with clients around the impact of remote working arrangements, as well as practices that can eliminate or minimize on-site visits and provide us access to supporting documents remotely. Another great example is with physical inventory observations and methods we can use to satisfy this requirement in lieu of on-site visits. And now I'm going to turn it back to Jen to go through a few of the best practices as we look to wrap up the presentation and head into our Q&A.
Thanks, Joe. Here's a short summary of the points that we hope that you can take away from this webinar. The first point, I've said this a few times, but it's super important that you should have multiple forecasts for multiple different periods, short-term and long-term, with the different assumptions that Joe spoke about. So develop an automated model that works for your company. Update forecasts for changes in actual results. This is to make sure that your forecast is presenting the most up-to-date information to make the most informed decisions off of. Then we have increased transparency with owners and lenders by regularly sharing the cash flow forecasts. Joe just mentioned this. It's especially important in times of uncertainty that you're sharing this information with your lender to help them see that you have a plan and that you're actively managing the situation. So now we're going to jump over to any questions that we have.
Thanks, Jen. We've got a few that have come in. Let me go through them. The first one is, when is the time to throw in the towel? Considerations on closing doors versus outright bankruptcy.
Yeah, I can step in and take that one. This is Joe. I know, unfortunately, some of you are probably facing that predicament. Hopefully not many of you. One of the things we would want to recommend is, hopefully before you get to that standpoint, you have gone through a full forecasting model, thinking about what Jen has gone through, not only in the short term, so looking at 90 days, but flex that out, look over 120 days, look into a full year plus. And also, as we mentioned before, go through all of the potential options for cash flow to your business. I know many of you have submitted for PPP loans. Many of you have heard back, and some may still be in the queue waiting for more information. I know we're anxiously awaiting Congress and hoping that there's going to be more funding available. So again, we would recommend, go through all of your options, go through all the potential funding, all the sources, before you have to make that difficult decision. And hopefully, there are other options or opportunities for you to seek that can at least keep the lifeline going for a little bit longer before you have to make that call.
Okay, next question is, how often should you update your forecast?
I'll take that one. It should be updated as things change. Any new information you get, it should be a kind of fluid process. Obviously, taking a look at it, if you're doing a monthly forecast, reevaluating it every 30 days is obviously recommended, because you can look back to see, so how was I compared to my actual results? Was there an assumption that I was missing or something that I overlooked? So I would say every 30 days, if you're doing a monthly forecast, that would be helpful.
Okay, and should I invest in a CD for the interest rate, or will that tie up my cash flow?
I can take that one, Jen. Again, I think that really depends on what your current forecasting looks like. To Jen's example, if you believe that you're going to have liquidity constraints and issues in the near term, it might be difficult to have some of those funds tied up in short-term CDs. If you think you may be good for the short term, it may be beneficial to the point there to invest in a CD or something with lower risk, with some sort of return there, where at least in the short term or in the medium term, the liquidity restraints may be minimal. So again, I would say focus on the forecasting model. If no immediate concerns in the short term, I would continue with looking into your investing means and measures, but definitely want to have a good model put together for the short and the medium term to understand if there's going to be potential constraints that come up in the near term.
Okay, we have one more question. Again, anyone that has one can shoot it in at any time, but we have one more here so far, and that is, do you have any suggestions on collecting older accounts receivable? Should I charge interest, or should I set up a payment plan, or give a discount to get paid now?
Yep, I can add to that one as well. I think there was a point we talked about a little earlier around, trying to understand your top 5 customers, understand what they're going through as well as what their forecasting is. So in situations where you may be able to give a discount to, one, improve your cash flow, but also give a customer a benefit or a break in the short term, that to me feels like good business. To the extent that you're not able to do that, I would say have open lines of communication. If you do need to charge interest, if you do need to talk internally around write-offs, do those sooner or later, so that you can build those into your models, so that you can have conversations with customers if interest is going to be charged. But again, it really depends on your forecasting, and then be open and transparent so that your customers can also build that into their forecasting as well.
Great. Well, that's about all the questions we have for now. This is Bill Doolittle, Director of Marketing, just giving you the questions here today. And we want to thank you all for participating in this webinar. We have contact information on the screen, so that if you do think of a question after we end this, please send either Joe or Jen a question. And again, we thank you for participating, and I'm going to end the webinar now.